Hello, we're going to give everybody about 30 seconds to trickle in. Last few folks. All right, and hello, and welcome to today's webinar, Charitable Planning Options for Retirement Assets, featuring Kyle Christofferson, Ren's Senior Vice President of Client Success. My name is Aaron Moncrief, and I'm the Senior Marketing Manager here at Ren, and I'm going to be helping Kyle with this webinar. To make sure audio is working and everyone can hear me, will someone let me know using the question box on the bottom right? Just let me know if you can hear. Great. You can use that chat box to ask questions as they come up during the webinar, and Kyle is going to do his best to answer them at the end. If we don't get to all of your questions, we will have somebody reach out after the webinar and answer any questions that went unanswered. This webinar is being recorded, and you should be getting the webinar sent to you tomorrow. You'll also be able to download the webinar deck that Kyle is going to be sharing during his presentation. Without further ado, please take it away, Kyle.
Well, good afternoon, everyone. I appreciate all of you taking the time to listen to this presentation today to talk about some different options that you can consider for your clients with retirement assets, which is most likely just about all of your clients are going to have retirement assets in one way or another. And what we're trying to do here at Ren is trying to provide you with thought leadership and resources, new ideas and strategies for thinking about how you can engage with your clients, how you can drive some positive impact with your clients through some charitable planning strategies that is both tax advantage and also is going to enable them to be able to achieve their charitable giving goals. So that's the reason why we're going over some charitable planning options today. One of the key tools that we will talk about is related to a donor advised fund. And with the donor advised fund, what we're going to be referring to is really specifically the Commonwealth Charitable Gift Fund. This is a donor advised fund program that allows you as the financial advisor to be able to manage the assets through an open architecture investment platform. Any publicly traded securities an allowable investment. And this really enables you to be able to partner with your client on charitable giving strategies while also being able to maintain the asset management for those charitable gifts. So it's a win-win scenario for your clients, for charity, and for yourself as well. So today, some of the topics that we're going to cover, we're going to really quickly go over the charitable giving landscape. What is the opportunity for charitable giving here in the United States? We're going to talk about the issue with the IRD tax, income in respect of a decedent, and also the estate tax and the impact it has on retirement plan assets. We're going to talk about some different planning options that you can do through the estate via testamentarily to get those assets to the heirs and also to charity, and then also some simple questions that you can ask your clients when you're talking to them about these charitable planning strategies, just a way to be able to engage with them, to bring to the surface what their charitable giving goals are and what do they want to accomplish. All right, so first we're going to go over the charitable giving opportunity. So as you can see here in 2021, this is a graph that shows the source of all contributions for charitable giving. And, I review this graph just about every time I do a presentation, and it's really just to lay the groundwork for how you're going to view the charitable giving market. A lot of times when I speak to individuals, speak to advisors, attorneys, they hear the number $484 billion of total charitable gifts in 21, but a lot of times they think automatically, well, that's probably more from foundations or corporations that are making those large gifts, because that's what you see in the news, that's what you hear about, and that's all publicity trying to improve public relations. But you can see the vast majority of the charitable gifts in 21 came from individuals themselves. 67% or 327 billion roughly. And so when we look at statistics that have been completed for client surveys, trying to understand what makes them tick, what the commonalities between them are, one of those questions that's commonly asked is, are you charitably motivated? Are you giving to charity on a regular basis? And 79% of those individuals have said, yes, I do give to charity on a regular basis. Charitable giving is important to me. So the odds are 8 out of 10 of your clients are giving to charity. So the question is, are you having those conversations with your client about their charitable giving goals to bring about more of a holistic wealth management approach to accomplishing not just their financial and estate plan goals, but also their charitable giving goals as well? Where did these charitable gifts go? We had $484 billion that went out to charity in 21, and you can see 27%, the biggest majority of those charitable gifts were directed to religious faith-based organizations, followed closely by 14% or $71 billion going over to education, such as private schools. It could be universities, colleges that you're wanting to support. And then this is followed up by those charitable organizations that are involved in human services, 13% or $65 billion. And then to grant-making foundations, such as community foundations, that was roughly 13% as well at $64 billion. So this gives you a good indication of where a vast majority of those charitable gifts are going that are given by, whether it be corporations or individuals, to the charitable community. Now, something that we have to keep in mind is when we look at charitable giving over time, is this something that ebbs and flows with the market, with the economy? Does it fluctuate over a period of time? A lot of times individuals think when you're looking at your client base, when you're thinking about your client's charitable giving goals, sometimes when the tax advantage aspect of charitable planning is not prevalent because of the economy or the market is down, you may also be inclined to think that charitable giving is down as well. But in fact, that is not the case. And in fact, what we see here from 2015, when the total charitable giving was at $373 billion, all the way up to 21, when it was $484 billion. So you can see that there is an increase year over year with charitable giving from 2015 to 2021. And this is despite the performance of the market itself. And going back to those surveys that we have studied and researched, 75% of donors are worried about others in the community during a recession, during a market downturn. 64% of those donors are worried about charities, not just others in the communities, but the charities themselves. They know that in times of difficulty, people are going to be needing more help, more assistance. And so of those individuals that are concerned about those charities, 59% of them are willing to give more to charity in times of a recession or times of poor economic conditions. So again, when we look at these numbers, 61.66% increase in total charitable giving just from 2017 all the way up to 2021. So before we get into the retirement plan options, I think it's important that we take a step back. Maybe those of you that are new to the industry, or just a quick refresher. Let's quickly go over the impact that the IRD tax and the estate tax has on a client's financial and estate plan. So first, retirement plan taxation. Very important to understand that, whenever you are the original owner of those retirement plans, you're able to put those monies into either, whether it be a traditional IRA or 401k, whatever it might be, and you're able to grow those funds tax-free. You're putting in pre-tax dollars, you're able to grow it tax-free, and that gives you the incredible opportunity to prepare for retirement, to boost the amount of assets you have available for retirement. The downside on that is whenever you make a withdrawal from that retirement plan, if you're able to when you hit your retirement age or at death, when it's transferred to the heirs, you have to keep in mind that all of that taxation, all of that income tax is going to be due when the IRA funds are withdrawn. So this is a way that you can grow your assets free of taxation, but you're always going to have that taxation on the backside when you go to withdraw those assets. This is why we took a look at, well, what can we do from the charitable planning side that can be tax advantaged and also accomplish the goal of getting assets to those heirs, so that they can use that for their lifestyle and create that family legacy through the generations. Another big change that we have seen just recently, we had the Secure Act a couple of years ago, but now we've been followed up by the Secure Act 2.0, which was signed by President Biden on December 29th, 2022. And it's in typical Congress fashion, we pass our bills at the very last minute, and they go into effect the very next tax year on January 1st. And this, of course, was no different. And this act affects a variety of issues, but is really built on helping improve retirement incomes and may provide you with additional ammunition to help create better outcomes for your clients. So let's quickly review some of the highlights for this act. You've probably seen a lot of articles, a lot of blog posts about this, so this may be a refresher for many of you. But first, automatic 401k enrollment for new plans that are created, and then employees are going to have to proactively opt out, which is different than what is being done prior to this act going into place. Next, there's changes to required minimum distributions, as the age for those RMDs required to begin have been pushed back up to age 75, and that's dependent on your current age today. And then next, we have no more RMDs from the Roth 401ks, which makes total sense. These are distributions that are not going to be taxed. And then third, we have better catch-up provisions for those that have 401ks, for those that have IRAs. So for example, if you're over 50 and you have a 401k, then you've got a catch-up provision of $7,500. And if you had an IRA, then it's a catch-up provision of $1,000. So what is the IRD tax? So, before I get into that, I did want to cover the qualified charitable distribution changes. That is an important topic as well. That's a really popular tool that a lot of clients are using today. So for charitable giving purposes, the QCD provisions, qualified charitable distribution provisions, have been approved by the Secure Act 2.0. And for those of you that are not familiar with this provision, what this does is enables clients to gift up to $100,000 from their IRA directly to a charitable organization as long as they're at least 70 and a half. So when this was originally enacted way back in 2006 with the Pension Protection Act, that's what the limit was. It was $100,000, and it has never changed since then. So what the Secure Act has done is now they have indexed this for inflation starting in 2024. So now the $100,000 limit for the qualified charitable distribution directly from your IRA to a charitable organization is now going to go up as inflation increases, which obviously is a concern in today's environment. So what is the benefit of this qualified charitable distribution? The qualified charitable distribution is really advantageous for those individuals that either A, want to get assets to charity and they don't need all the funds available in their IRA, or B, they have to take an RMD because they are at that required age where they have to start taking the RMD payments, and they are concerned about the taxation that it's going to cause on their personal tax return, and they would just rather give it to charity. Well, instead of taking that RMD, now they can distribute up to $100,000 to their favorite charity. It doesn't get a maturity deduction, but it also is not going to be taxed to them, and it goes towards that RMD requirement. So this is a significant win for individuals. A last provision on this qualified charitable distribution rule is the fact that now you can also give a one-time gift, not every year, but one time, up to $50,000 from your IRA to fund either a charitable gift annuity or split interest trust, such as a charitable remainder trust. So it doesn't make a lot of sense if you are going to fund a brand new charitable remainder trust for $50,000. We'll get into that in a little bit further along in the presentation. But could be a good additional contribution to a charitable remainder trust, could be a good addition to a new charitable gift annuity. All right, so example one, we're going to focus in on the IRD tax, which is income in respect of a decedent. So this is the issue that has really driving why we're looking at charitable planning options for retirement assets. So in this simple example, we're looking at a donor that's got a $2 million estate with $500,000 in an IRA. So they don't have to worry about an estate tax problem, but they are going to have to worry about that IRD tax calculation. So if the IRA is going to go directly to that individual, then you're going to have to pay tax on those assets coming out of the IRA. So you've got an IRD tax of 39.6%, which is going to be $198,000. So you've got $198,000 of that $500,000 gift, or $500,000 IRA is going to be going to the federal government in IRD tax. Now, in this example, this is made a little bit worse. This was taking into account the estate tax exemption rate from 2022. But say that this individual has, instead of $15 million estate, they have a $16 million estate. The current estate tax exemption is 12.9 roughly for 2023. But with this individual, the IRA value is going to be included in their taxable estate, which, if that's at the highest estate tax rate, we can assume 1.2 million is going to be included. What this means is now we've got a $1.2 million a 691C deduction that we can claim against our IRD tax calculation. So how that works is, first you're going to be taxed at the estate level for that IRA, then you're going to be taxed at the IRD level that we went over in the prior example. So the IRA value we'll assume is 3 million. We've got 3 million of ordinary income. We've got the deduction, the 1.2 million in estate tax that we've already paid. So that reduces the amount subject to tax from the IRA to 1.8 million. And then you multiply that by the IRD tax rate of 39.6%, which causes a tax of $712,800. So by the time that you're all said and done with paying the estate tax, paying the IRD tax, you've got roughly 1.9 million of that 3 million that's going to be going to pay taxes. That's a big chunk of our traditional IRA that we have in this example. This is why it's so important to think about how can we do a better job of giving our clients options to make this a little bit more efficient as they go into their testamentary estate planning. So what are these testamentary planning options? The first one is to name a charity or donor advised fund, such as the Commonwealth Charitable Gift Fund, as a beneficiary. So whether it's going outright to a charitable organization, a public charity, or to a donor advised fund, the exact same rules and impact will apply. You could also, in option number 2, you could name a charitable remainder trust as beneficiary for spouse or child. This is a great example for someone that wants to get assets to heirs, but maybe they're a spendthrift. Maybe the parents are concerned that the children are just going to take those monies and go out and buy a couple new Corvettes or a boat or whatever, when the intention from the parents was to be able to provide them an income stream for the rest of their lives. The CRT gives you the most flexibility as far as how that's going to work, as far as distribution rates, whether it's going to be deferred for a period of time. The other option that's a little bit simpler is an immediate charitable gift annuity that's going to provide an income stream to those heirs. So the first option, again, this is the most straightforward option. And so what you would do on the retirement plan form is you would just simply go in there and you would look at the beneficiary designation. If you wanted to name a charity directly, what would happen is you would just list that charity name in the beneficiary designation area. And if you wanted a donor advised fund, then what you're going to be naming is the name of the sponsoring charity of that donor advised fund program. So for the Commonwealth Charitable Gift Fund, you would name it for the Renaissance Charitable Foundation for benefit of the Kyle Christopherson Family Fund, whatever the name of that donor advised fund is going to be called. This is the way that you can get this IRD asset over to charity and remove that asset from the estate entirely. So you're going to avoid the estate tax associated with that asset. You're going to avoid any IRD tax associated with that asset, because ultimately those assets are going to a tax exempt entity. It's not required to pay a state IRD tax, and also provides a dollar for dollar deduction against that IRA. What you always want to keep in mind is whenever we're looking at these options, and we're going to go through an example in the next slide to show you exactly the impact of just adjusting the beneficiary designations, where these funds are going from the qualified retirement assets to make sure that it creates the most efficient solution possible for your clients. Also, we're going to talk about the donor advised fund in a little bit more detail as well. The key thing to know about the donor advised fund, it is a great solution to involve the heirs, to involve the children, that next generation. Why is that important? Well, when you're working with your clients and they pass away, do those assets typically remain with you, or do they go to the children and they have their own financial advisor? Statistically, about 80% of assets transfer to a new financial advisor when the parents pass away. So what the donor advised fund enables you to do is you're going to be the financial advisor in that donor advised fund. So when the parents pass away, the children are going to be the grant advisors, making the grant recommendations to where those funds are going to go to charity. And you're going to be managing the assets. So you're going to be interacting with them, having meetings with them, and you're going to have that opportunity to create a relationship. So IRA payable to the estate. So in this example, we have an individual that has two assets. There's no liabilities. We're keeping it very straightforward and simple. He has a $1 million IRA account and a $1 million in just a non-qualified investment account that has publicly traded stocks. And this individual wanted to benefit equally, 50-50, his son and also a charitable organization that he had been supporting throughout his life. And unfortunately, they just listed both of them as beneficiaries for both of these accounts. So what happens is you've got 50% of the IRA goes to the charity, 50% of that IRA is going to go to the son. 50% of the stocks are going to go to the charity at $500,000. 50% of the stocks are going to go to the son at $500,000. Well, because $500,000 of that IRA went to the son, an individual, taxable individual, you're going to have to pay IRD tax, which is 37% of that $500,000 or $185,000 in taxes. The net amount at the end of the day is $1 million that goes to charity and $815,000 that's going to go to the son. Now, there's a way that we can revise this strategy by being more direct in how we're thinking about how we want to structure the beneficiary designation form for both of these accounts. So knowing that the IRA asset is going to trigger IRD tax, we can cause that to be shifted 100% to the charitable organization because we know we're not going to have to worry about the IRD tax, and then shift the full value of that stock portfolio in that non-qualified account over to the son. Now, because they don't have an estate tax to worry about, we don't have to worry about any portion of the assets from the son getting eaten up by estate taxes. He has no qualified assets that are coming to him, so there's no IRD income tax that's going to be due. So at the end of the day, with this revised plan, we've got 100% of $1 million going to charity, 100% of $1 million going to the son. So this is just the way it's $2 million. We've avoided all the taxation. It's just about making sure that those qualified assets, if your client has charitable goals, making sure those qualified assets are going to charity first before those non-qualified assets to avoid that IRD income tax. So for those of you that don't understand, or maybe you haven't worked with a donor advised fund before, this is just a real quick refresher on it. A donor advised fund is very similar to having your very own private family foundation. So if you've heard in the news, Bill and Melinda Gates Foundation is the largest non-operating private foundation in the country, roughly about $40 billion of assets, give or take. And what they do is they simply make not grant recommendations, but they make grants out of their assets to other public charitable organizations that are aligned with the charitable mission and charitable objectives that they're looking to accomplish, whether that be looking for a cure for a chronic illness, cancer, trying to end poverty, to support education. That's what the Gates Foundation has been known to do. And that's that same look and feel that you can get for a donor advised fund. You can call the donor advised fund whatever you'd like to call it. So you are setting up an individual giving account with a public charity, so that when you make that gift of, say, $50,000 to fund a donor advised fund, you get a $50,000 charitable deduction, just as if you gave it outright to any other qualified charitable organization, such as the university, such as a faith-based organization. And the difference is, instead of it being a completed $50,000 gift, well, now over time, you get to determine what charity receives what amount every year. So you could decide, I want $500 to go to the Humane Society. I want $1,000 to go to this local community foundation, another $1,000 to go to the food shelter. Whatever those charitable organizations that you want to support, as long as it's a qualified public charity, you can make the grant recommendation to those organizations. And the great news is there's no minimum or maximum to the number of grants that you make from the Commonwealth Charitable Gift Fund every year. In addition, you can call it whatever you'd like to call it. You could call it something very generic, such as the Central Indiana Charitable Giving Fund. It could be the Kyle Christopherson Family Fund. You've got flexibility to do that, because when those grants go out to those charitable organizations, it's going to reference that name, your name, and the name of your donor advised fund account. You can be anonymous if you wanted to, but a lot of people like to recognize either the name of the donor advised fund account or themselves individually for where that grant recommendation was initiated from. Now, are DAFs popular? Are they growing year over year? And I think what you're going to find here is that even when looking at the donor advised fund market, it's really synonymous with the charitable giving market as a whole. You'll notice that it's growing year over year, regardless of the economic activity that you see out in the marketplace. So from 2016, we show that the total value of the donor advised funds, when we look at every donor advised fund program in the country, the total value of all those programs was right at $80.6 billion in 2016. And just 5 years later, that has almost tripled to $234 billion of total assets. And in addition, we have $1.28 million or 1.28 million different donor advised fund accounts in 2021. Whereas in 2017, for example, there was only 471,000 accounts. So this is a tremendous growth. And you can see the growth in 21 when it jumped from 159 billion to 234 billion. That's almost a 50% increase in the total value of donor advised funds. And so this is a trend that we've seen now for decades, as looking at the historical growth pattern related to donor advised funds. So why are donor advised funds so popular? Well, because it's an opportunity to streamline your charitable giving. You can, if you're giving to 10 or 15 different charitable organizations, you can now make a single contribution into your donor advised fund account and support those 10 or 15 different charitable organizations from a single source, from a single record source. That means you've got one gift receipt letter that you have to give your tax preparer every year, instead of trying to track down 10 to 15 different gift receipt letters from all those organizations. Also, it's a very small amount to get you started, which means that the demographic for who this would apply to is not limited to the ultra high net worth, the high net worth, or those with significant disposable income available. This is a tool that just about everyone, regardless of their demographic, is able to participate in and take advantage of in some way, shape, or form. We have some donor advised fund accounts on average that, might be less than $10,000, and we've got some donor advised fund accounts that are several $100 million in total assets. So again, a wide demographic of clients that are going to use this tool. So let's shift gears and talk about the second option. Again, this is a strategy that's very important if you have a client that wants to make sure that their children are going to receive an income stream for the rest of their life. So whether they need income just to supplement their lifestyle, or whether they're concerned that they're not going to be good stewards of their money, that they might spend it on frivolous, maybe fun stuff that the parents don't want them to spend it on. This is a great strategy that instead of going outright to a charitable organization, it can provide an income stream to the heirs, the children first, and then whatever's left over would then go and support the charitable organizations that are designated. So how this works in difference to just an outright gift to charity or to a donor advised fund at death is the estate tax deduction that the client's estate receives is not going to be a dollar for dollar estate tax deduction. It's actually equal to the present value of what eventually is going to pass on to the charitable remainder beneficiary, the charity that's going to receive whatever's left over. And that makes sense because you can't get 100% charitable deduction when there's an income stream coming out of a charitable remainder trust to support that child or heir for a period of time, whether it be a term of years or whether it be for their life. The CRT is not going to have to pay the IRD tax. So if you do transfer that IRA asset, that qualified asset, into a charitable remainder trust, there's not going to be any immediate taxable event related to that IRD. Now, the problem, though, is that IRD taxation that would have been due is now populating the ordinary income tier of the charitable remainder trust, which means plan on the charitable remainder trust distributions to the heirs, to the children, being taxed at ordinary income rates for a significant period of time, if not the entire time, most of the time that they're receiving an income stream. And then finally, the 691C deduction is not going to be able to be used on the personal estate because it was received by the charitable remainder trust. The charitable remainder trust did not actually pay any IRD tax on that or estate tax on that qualified asset. So what are charitable remainder trusts? So for those of you that are not familiar with charitable remainder trust, this is a separate legal document or instrument that you're going to set up with an attorney. You basically set up a trust document that says, okay, this child, this heir is going to receive income for a number of years, or maybe it's for their life expectancy. It's going to specify the distribution rate, which has to be at least 5% a year. And whatever is left over when the term expires, when the child passes away, that amount is what ultimately is going to be paid out to the charitable organization. And it could be one charity, it could be 5 charities, it could be 10 charities, or what's very popular is it could be a donor advised fund. So again, you could bring in the Commonwealth Charitable Gift Fund solution into this option as well and allow the grandchildren to be able to participate in this charitable gift that was structured by the grandparents originally. The third option is a little bit simpler than a charitable remainder trust. So if you're looking at what client's going to work best for a charitable remainder trust, typically it's going to be a client that can contribute at least $250,000. And I really recommend trying to get that as close to $500,000 as you can. Really to make it worthwhile for a charitable remainder trust, by the time you hire an attorney, draw up the trust document, take care of the annual administration work, anything less than that, it just doesn't make sense. It's going to cost more in expenses than it's going to provide in benefit. But for those clients that you're going to have less than $250,000 going to in an IRA asset, you could have this go to charity for the purpose of setting up a charitable gift annuity for your heir, for the child. And how this will work is that the charity is going to agree to pay X amount of income. It's going to be an annuity payment for the rest of that child's life, and it's going to be based on whatever their age is at the time that they pass away, and whatever that child's age is when the parents pass away. So it's going to be based on whatever the charitable gift annuity rates are in effect at that point in time. And the reason why that's important is because with charitable gift annuities, you can't go over there and say, well, I want 8%, I want 7%, I want 9%. There is the American Council on Charitable Gift Annuities that publishes the recommended rates that should be paid out to each individual based on their age, based on their life expectancy. And so whatever their age is what they'll get paid out. And it's an important part because charitable gift annuities are paid directly by that charitable organization. So if they ever run out of all the assets that were used to fund that charitable gift annuity, now they have to pay that income stream out of their own pocket for as long as that child or heir is alive. The estate tax deduction issue is going to be very similar to the testamentary charitable or trust option that we discussed earlier. It's a present value of what's projected to go to charity at the end of the beneficiary's life expectancy. And the IRD tax, again, is going to be to the charity that received that IRA or that qualified asset, not to the estate or the annuitant. So for some of you that are not familiar with, having these charitable giving conversations, maybe it hasn't come up, maybe your client hasn't brought it up. What I would encourage you to do is that the charitable conversation that you can have with your clients, it's a great way to deepen your relationship with your clients. You're going to be asking them questions about, what charitable organizations that they want to support, what is their passion, when they tell you they're charitable organizations that they want to support, why is that? And what that does is allows you to get to know your client a little bit better. It allows you to understand what they're passionate about, what they believe in, and so that you can understand them on more of a personal level. And in addition to that, when we go back to the stats I said at the onset of this presentation, 79% of clients are charitably minded. So those clients are either figuring out how to give to charity and support charity on their own directly, or they're going to someone else. Someone else, if it's not you as the financial advisor, someone else is that trusted expert that they're going to figure out what charitable planning options are available to them. It could be just a single charitable organization that they go to and get that support. It could be multiple organizations that they're going to. But whatever it is, there's someone that they're reaching out to get those charitable giving advice. And so by bringing this conversation up, what we've seen financial advisors be able to do is strengthen the relationship, not because we understand the client on a more personal level, but now this client is coming to you for every question, for every piece of advice that they're looking for, whether it's estate planning, college planning, the financial retirement planning, whether it's charitable planning. All these aspects can be covered by your guidance, by your expertise to help enable them to make the best options per their situation. And these questions that we use as kind of a conversation starter. And there's so many questions that you can ask the client, but this is just a way for you to utilize these and see if this prompts some discussion. And they're designed to be open-ended questions so that it's not just a simple yes or no, which we all know doesn't really draw a lot of information out from the clients. The first question is, would you like to learn how to consolidate your charitable giving while considering your tax planning needs? So we're talking about, options to streamline charitable giving, to make it easier, to be able to put it in a vehicle that you could invest, get a rate of return on through investment in stocks and mutual funds, whatever it might be, and get more to charity because that income and earnings is not going to be taxable to a donor advised fund account, for example. Second question, your family has built a strong philanthropic reputation in your community. Have you considered creating an approach to continue this legacy for future generations? Are you concerned about your children, your grandchildren, your great-grandchildren? Do you want to make sure that you've got tools in place that's going to draw them into charitable giving, to expose them to what it means to create that philanthropic legacy? There's charitable tools that can help future generations to be involved without using their own assets. Instead of using already tax dollars and writing checks to your favorite charities, have you considered donating appreciated securities to a donor advised fund? So again, does your client have assets that are highly appreciated? And this isn't just for stocks, bonds, or mutual funds rather, but this could also be assets such as a closely held business. It could be assets such as real estate, a collectible. It could be even crypto. Any asset, whether it be a complex asset that's not sold or bought on the public exchange, or whether it's a publicly traded stock or mutual fund, all these assets are possible candidates for a contribution to charity. And at Ren, we've got a team here that's dedicated to simply helping figure out if a complex asset, such as a closely held business or real estate, is a good candidate for a charitable giving strategy to get dollars to charity and also to create a tax efficient strategy for the future for your clients. Last but not least, when you do convert that illiquid asset, now you've got additional assets that you're able to manage for your client and deepen that relationship through that as well. Maybe they created a windfall income event. Maybe they received a large bonus check, or maybe they went ahead and sold a complex asset without telling you about it first. Well, there's still some strategies that we can utilize through charitable giving to help offset some of that taxation, to get a charitable deduction, and be able to make their situation a little bit better. We had a situation late last year with a client that came to the financial advisor and said, hey, I got these proceeds from the business I sold. I just want some CDs. And that was it. And fortunately, the advisor said, hey, have you heard of this thing called a donor advice fund? We can put some money in, get a deduction, help offset some of that taxation. And they did that and were able to save the client over $35,000 in taxes. So definitely number 4, good strategy for those clients that come to you after the fact and let you know that they've already liquidated that highly appreciated asset. So we talked about this. What is strategic charitable giving? What is the benefits that it can provide for you as the financial advisor with your client? Again, providing a tax smart, simple, charitable solution, increasing those tax savings, increasing the opportunity to give more assets to charity. It deepens that relationship that you have with your client. And we talked about this briefly, but creating a venue for the next gen, being able to create that relationship, that connection with the children, so that when those assets pass from the parents to the children, you can stay with the family and remain the family's trusted financial advisor, not just the parent's financial advisor. Donor advice fund, charitable maintenance trust, all those tools are great strategies to be able to start having conversations with those children. Increasing assets under management, we talked about this, unlocking assets that are not publicly traded, such as those closely held business and real estate, so that you don't have to worry about the taxable event associated with getting those assets liquidated and in a diversified portfolio. So I know we are coming up on our time. I wanted to make sure I saved a few minutes just to go over any questions that came up and see if we can go into any more details a little bit further that maybe I went a little too fast on, or you had additional questions.
Yeah, thanks, Kyle. If there's one thing that you could clarify, we had a couple questions. I think your audio cut out for this, but what was the new limit on QCDs currently?
Yeah, that's a good question. For the QCDs, the qualified charitable distributions, right now for 2023, if you're looking to make just a qualified charitable distribution directly from your IRA to a charitable organization directly, it's $100,000 per individual as long as they are at least 70 and a half years old. Now, in 2024, that $100,000 limit will begin to be indexed for inflation. So it's going to be rising beyond that $100,000 mark every year, similar to the way that the federal estate tax exemption amount is indexed for inflation as well. The other side of this is this new provision for qualified charitable distributions, where instead of having it go directly to a charitable organization, you can make a one-time election to have up to $50,000, which is the limit for this strategy. Up to $50,000 go to a split interest charitable planning option, such as a charitable gift annuity or charitable remainder trust. But again, that's a one-time option of $50,000, not an annual event that you can do.
To follow up on that, can a person turn a QCD into a DEF? Make a QCD to a DEF?
Yes, unfortunately, the qualified charitable distribution, the way that the law was written, is very specific that it has to go directly to a public charity. Now, a donor advice fund is sponsored by a public charity, but the donor advice fund is specifically restricted from qualifying as a recipient for a qualified charitable distribution. And I guess the thinking behind that, the commentary from Congress on that was they felt that the client would have too much control because they can make grant recommendations from a donor advised fund. They want it to go immediately to the charitable organization and used for its mission. So a donor advised fund cannot receive funds from a qualified charitable distribution without creating a taxable event.
Another question we have is, I am using the DAF to generate a deduction to allow a tax-free Roth IRA conversion. How common is this strategy?
This is a very common strategy for Roth conversions. There's a lot of individuals that are looking to convert from your traditional IRA to a Roth. Obviously, when you do that, you're creating a taxable event at that point in time, hoping to grow it. And then later on, you're better off because now you can make those tax-free withdrawals from the Roth. There is a well-documented strategy of utilizing the donor advised fund to make additional contributions to or just a single contribution, if it's a single event, to a donor advised fund to get a charitable deduction and use that charitable deduction, that dollar for dollar deduction, to offset the taxable income from that Roth conversion. And we actually have a couple donor stories that just lay out in a one-page document that shows here's how this strategy would work. And it goes through a story such as John and Jane Smith. We're doing a Roth conversion. Here's how they use the donor advised fund to offset that taxable event. Definitely a very good strategy. It's very popular. Definitely recommend looking at that if you've got clients that are looking to do a Roth conversion.
All right. What kind of client is best to target when advising this type of tax opportunity? I'm assuming they mean DAF.
Yeah, so for a donor advised fund, I would say you're looking for a client that gives to charity on a regular basis. So whether that be for someone that gives to a single charitable organization every year, or maybe they're giving to multiple charities every year, that's definitely someone that's going to be a good candidate. Most of the clients are giving to a charitable organization on a regular basis. The donor advised fund is also ideal for someone that needs a charitable deduction. Maybe they don't know for sure which charity they want to support. So at the end of the year, their taxpayer comes up to them and says, hey, you need to get a charitable reduction of X amount. You got to get it done. It's 3 days till the end of the year. They don't know what charity support. They can put it in a donor advised fund, get that charitable deduction, and then they can figure out over time what charities that they want to support through the grants from that donor advised fund. So someone that's looking for the ability to streamline their charitable giving that occurs on a regular basis, someone that's looking for that large income tax deduction, someone that wants flexibility in when the charities are receiving donations or grants from that donor advised fund account. I'd say another avenue is if you're wanting to involve your children, involve the family in a philanthropic legacy that can be passed down from generations. The donor advised fund is definitely a great tool to do that, because when the parents pass away, the children can take over as the successor grant advisors. They can make the recommendations for their life. When they reach the end of their life, if there's funds still in that donor advised fund account, they can then make the grant recommendations. The great grandchildren now, or the grandchildren now, can make those grant recommendations. Then it passes on to the great grandchildren. If you've got children that don't get along with each other, you can split that donor advised fund account into separate accounts so that they can each have their own portion to make grants from. So it's a lot of flexibility that you can instill by creating this one-time gift in a donor advised fund or multiple gifts during your lifetime, creating this nest egg that the future generations of your family is able to benefit and support charities through those funds. And again, because you're investing those assets in stocks and mutual funds, you're getting a rate of return. It's growing tax-free, just like it does in any qualified retirement account. And there is never any taxation, even when you're making a grant out to another qualified public charity. For charitable remainder trust, just make sure we have our bases covered. Charitable remainder trust is really ideal for someone that's looking for that income stream. They want the benefits of the donor advised fund, but they need an income stream. They can't just give away that asset entirely and be able to meet all of their ongoing lifestyle expenses, needs, and so on. So charitable remainder trust, if you need an income stream, if you're trying to avoid capital gains tax, donor advised fund, charitable remainder trust, charitable gift annuity, outright gift are all going to be able to avoid that capital gains tax.
Looks like we'll have time. We have time for one more question. And in your opinion, when is the best time to start talking to my clients about these planning options for their assets as part of their estate plan or before?
I would say as soon as you can. You want to be able to identify those clients that are going to be good candidates. If you've got clients that have highly appreciated assets in their portfolio, if you notice that they're making those charitable contributions, when you speak to them next, when you have that next planning meeting with them, bring up these charitable questions, bring up the charitable conversation, see where that conversation takes your meeting. Does it go into a need or desire to streamline or make it more formal their charitable giving goals and tools that they're going to utilize? So as soon as you can, because the reason why I say that is not just because it's an important conversation to have, but if they want to structure a charitable gift, it has to be completed by the end of the year in order to qualify for a charitable deduction in 2023. So if you're wanting to do a charitable remainder trust, you do not want to wait until December to start having that conversation, getting the document drafted. If you want to do a donor advised fund, it does not take as long to do as it would for a charitable remainder trust, but you still want to make sure that you've got a few weeks before the end of the year to get it set up, to get it properly funded, to make sure that you're going to get that charitable deduction in time to be able to utilize it for your 2023 tax bill.
And thank you. Thanks, Kyle, for that. And thanks, everyone, for joining today's webinar. And again, thank you, Kyle, for presenting. Like I said before, this webinar was recorded, so you should have access to the recording email in the next day or two. We'll try to get that sent out to everybody tomorrow. We'll also have somebody reach out to all the unanswered questions. And if you have any more that come up, please reach out to us by filling out the contact us at reninc.com, or you can go directly to us at consulting@reninc.com. That'll get you connected directly with Kyle and his team. Have a wonderful rest of your day and week. Thank you all for joining.